As we sit here today, August 11th, 2010, we have reached the, quote, repeal of the estate tax. This is what was promised when EGTRA was passed back in 2001. And the whole idea of EGTRA was we were going to go through a 10-year transition period to reach where we are today, and that is, quote, the repeal of the federal estate tax. And we just finished discussing what does that mean to us as practitioners. We discussed planning for the remainder of 2010. We talked for about dealing with states of decedents that die in 2010. And then we talked about how do we prepare for the beginning of 2011 and what happens in 2011. For decedents that die this year, it's a tough year for fiduciaries as well as for the attorneys that represent fiduciaries. And the reason for it is, number one, we have uncertainty as to about whether or not there's going to be some sort of a retroactive repeal. And then the biggest issue that we have to deal with is dealing with the Section 1022 modified step-up in basis. And unfortunately, we don't have a lot of guidance there. The statute itself simply says that the personal representative is the person who makes the allocation, but there is no guidance as to how that allocation is to be made. This will create a number of issues for fiduciaries, possibility of disputes over interpretation of marital deduction planning clauses that were drafted for a time when there was a federal estate tax and there was no Section 1022, disputes among beneficiaries as to which assets are to receive the allocation. And as a result, we as the attorneys representing fiduciaries are going to need to make sure that we take these into consideration when we enter into an engagement to represent the fiduciaries of these estates. We'll need to make sure that we fully advise the fiduciaries of their responsibilities, make sure that the proper forms get filed. Then as we turn toward 2011, this is really where it kind of becomes exciting. If you look at EGTRA, at the time EGTRA came in, again, it was heralded as the repeal of the federal estate tax. And we had a 10-year introduction into this repeal that took place between 2002 and 2009. Then 2010 was supposed to be the first year of federal estate tax repeal. And by first year, the anticipation was that we were going to go on in the future and continue to have estate tax repeal. Well, that hasn't played out. If we look at the EGTRA law, Section 901, which is the sunset provisions, there's two provisions of that. Provision A says that EGTRA no longer applies for plan years decedents dying after 2010. And then the Section B is kind of the one that we've had some interesting conversations, to say the least, thoughts about what does it mean. And it basically says that the Internal Revenue Code for descendants dying after December 31st and also for tax plan years, in other words, any tax years after 2010, are to be applied as if EGTRA never existed. And so what does that mean for us? Well, the first thing it means for us is that we return to the $1 million exemption that came in under the Tax Relief Act of 1997. We also return to graduated estate tax rates from 41 to 55%. This means that for us as planners, tax-motivated estate planning will become much more important than it has over the last 9 years. Over the last 9 years, we've seen a decrease in tax-motivated estate planning because of the increase in exemption amounts. Now all of a sudden this next year comes and we are reverted back to the $1 million exemption. So almost all, in particular married individuals that we deal with, will have to deal with probably AB trust planning. So we're going to want to make sure that we include AB trust planning. Advanced planning will also become much more important. ILETs will all of a sudden become a very popular planning tool to help create liquidity to deal with paying the federal estate tax that will now become due in a much larger percentage of estates. Charitable planning will become much more motivated. We're going to see a lot more use of qualified personal residence trust. We're going to see a lot more use of grantor retained trust. Even for the, quote, what we used to consider a more modest estate, you're going to see motivation to create family entities such as family limited partnerships, family limited liability companies. You're going to want to see sales to intentionally defective grantor trust, or what we commonly called grantor or GDOTs, grantor deemed owned trust. One of the things that we're going to continue to have to deal with is the fact that we will probably continue to have change. And how are you going to want to deal with that? One is obviously in the initial drafting to include drafting strategies that we've had in Wealth Docs for some considerable time, the so-called wait and see strategies, the use of the Clayton election or the use of the disclaimer. A lot increased reason for using trust protectors to deal with amendments, to deal with possible changes in the tax code, granting the trust protector the ability to give a beneficiary a general power of appointment, because much more of a important power, because we don't know what the federal exemption amount is going to be in the future. And also deciding how we want to, whether we want to continue the engagement with the client through some sort of a client maintenance ongoing relationship, or whether you're going to want to terminate that relationship by a disengagement letter. I think we're going to see a glimpse of the future if you look at the idea that a lot of practitioners are already doing, and that is not to terminate the agreement or disengage, but to continue that agreement or continue that engagement under terms that you define, so that you clearly define what the attorney's responsibility is, as well as what the responsibility of the client is going to be. So it definitely is an exciting time that we're looking for. I actually think it's going to be a great time to be an estate planning attorney, and nothing that we should be afraid of.